Chapter 1 gives a brief overview of topics we'll be covering in more depth in future chapters. Markets and institutions involves a lot of terminology, some of which you may never have heard before. While some will be introduced in this chapter, don't panic, we'll be covering everything in more detail as the class unfolds. Financial markets and financial institutions are the middlemen between users of funds and suppliers of funds. Efficiently transferring capital between those who need it to those who have it benefits the economy in several ways. It increases wealth. It provides income, provides economic opportunity. In this class, we'll examine 2 of the 3 items on this slide. We need to understand the structure and operation of both domestic and international markets and how funds flow through both. Financial markets are one, but not the only structure through which funds flow between demanders and suppliers. Financial markets are usually described as primary versus secondary, money versus capital markets, and we'll define and discuss each of these. Primary markets are where funds are raised by issuing new securities. This is where IPOs occur. Issuers tend to be corporations or government. Securities are stocks and bonds. The defining factor, funds raised go to the issuer. Secondary markets are those where financial instruments are traded among investors. These are the markets we're more familiar with, NYSE and NASDAQ. The New York Stock Exchange is considered the listed market, an exchange. NASDAQ is considered the over-the-counter market. Now, ECNs, electronic communication networks, allow direct electronic trading among buyers and sellers without a third party. And 2 former ECNs, BATS, which was formed in 2005, and Direct Edge, formed in 1998, merged in the fall of 2013 and applied to become an exchange. The combined entity makes them the number 2 stock market ahead of NASDAQ, but behind NYSE. This highlights the defining difference between primary and secondary markets, as already mentioned. In a primary market, the funds flow directly to the issuer. In a secondary market, the funds flow is between the buyer and the seller. The issuer of the underlying security has no gain in the transaction. Fund issuers in a primary market typically use the services of an investment bank to organize and facilitate the process. They act as intermediaries between the issuer and the buyers. Otherwise, the issuer would be required to make a market in the security. There are 2 basic types of offerings in a primary market. An IPO, an initial public offering, is the first time a firm offers stock for sale to the public. A seasoned offering is when a firm who already has stock trading in the public market offers more shares for sale. Secondary markets are, as mentioned, the ones we're familiar with: New York Stock Exchange, NASDAQ. This is where you and I can buy and sell shares of stocks and bonds. Creating a central marketplace is critical to enhancing the liquidity of an issue, the ability to buy and sell securities quickly without significant loss in value. Additionally, secondary markets provide price discovery. How much is a share of Apple worth? Check what it's trading for right now. That's what it's worth to an investor today. Transactions in U.S. secondary markets are extremely fast and very transparent, providing a high degree of efficiency. So how does the existence of secondary markets affect primary markets? Secondary markets add liquidity for risky investments and encourage investment in primary markets. Secondary markets also aid in price discovery, providing up-to-date signals of the ongoing value of a firm. These signals also provide benchmarks for corporate performance. It is not true that secondary markets are simply a legalized form of gambling. The second dimension for categorizing financial markets is money markets versus capital markets. Money markets are those that trade debt securities with maturities of 1 year or less. CDs, treasury bills. Low return, low risk. Capital markets trade stocks and bonds with maturities more than 1 year. Significant risk, but potential for higher return. Notice with the 2016 data, T-bills are now about 1/4 of total money market instruments. Bankers' acceptances continue to be used less due to their cost and the growth of other trading arrangements. Bankers' acceptance have traditionally been used to finance international trade, where a bank is asked to guarantee payment on a commercial contract in case the buyer of the goods does not or cannot pay. The commercial paper market collapsed during the financial crisis and has grown more slowly since. Commercial paper is an alternative to a bank loan and may provide a cheaper source of financing for large, well-known companies. A repurchase agreement, or a repo, is best thought of as a short-term collateralized loan as compared to a Fed funds loan, which is uncollateralized. In a repo, one sells a security and agrees to buy it back at maturity at a higher price that is set at the time of the contract. As of mid-March 2009, the Dow Jones Industrial Average had fallen 53.8% in value in less than a year and a half, larger than the decline during the market crash of 1929 when it fell 49%. Stock prices recovered, along with the economy in the last half of 2009, rising 71.1% between March 2009 and April 2010. Foreign exchange, or FX markets, trade currencies. Spot FX is for immediate, usually meaning delivery within 1 or 2 business days. Forward foreign exchange are customized agreements to exchange a specific amount of one currency for another at a chosen date in the future. Forward and futures are not the same. Forward markets are customized. Futures markets are standardized, as we'll see in the coming chapters. Derivative securities, one of my favorite topics. A derivative is exactly what the name implies. The security derives its value from another security or commodity, termed the underlying asset. Derivatives include both options and futures, and while similar in some ways but differing along several dimensions, they share a common goal: to transfer risk between market participants. Both options and futures involve transferring a set quantity of an asset at a set price at a specified time in the future. Derivatives will be some of the last chapters we cover in this class. Derivatives may be either exchange-listed or traded over the counter. Exchange-listed securities are more regulated, more transparent, and generally involve no default risk for the counterparty. Over-the-counter derivatives are non-standard, largely unregulated, and may involve substantial counterparty credit risk. Counterparty risk means the other side of a transaction may default. Now, forward rate agreements are prearranged loan contracts with the loan term set now, but with the drawdown in the future. U.S. financial markets have been strongly regulated since the Great Depression. The Securities Act of 1933 set up securities registration, full and fair disclosure. It was clearly driven by the Depression. The Securities Exchange Act of 1934 established the SEC, the Securities and Exchange Commission, as the main regulator of securities markets. The United States SEC is the gold standard in terms of market regulation, and it serves as the benchmark for many countries designing their own market oversight regulation. We've looked briefly at financial markets. Now let's turn to financial institutions. 2 types: depository and non-depository. Institutions that accept insured deposits must be regulated by the government to offset the government's liability. Insured deposits are a low-cost source of financing, but the regulatory burden increases these institutions' costs significantly. Financial intermediaries that receive contractual payments, such as life insurers, pension funds, property and casualty insurers, have steady premium income to invest. This allows them to take on more risk in their investment portfolio. Here are examples of both types of financial institutions. These should be more familiar to most of you. Depository institutions, commercial banks, credit unions. Non-depository includes 2 subtypes: contractual, meaning you contract to pay in a certain amount each period. Insurance companies and pension funds come under this. Non-contractual, you invest when you want to. Securities firms, mutual funds. Note that over time, the percentage of funds invested with commercial banks and insurance companies has declined, while the percentage in investment companies and mutual funds has steadily increased. Both financial markets and financial institutions are considered financial intermediaries, since they facilitate the flow of funds between those that have and those that need, users and suppliers. So what's so important about their function? What if we didn't have them? Those that have funds to invest would have to personally seek out good investments, make contact, and then monitor them. Those needing funds would have to seek out those with funds individually and convince them to invest. Very inefficient. Financial intermediaries are exactly as they are named, intermediaries. They match suppliers with users, providing oversight and monitoring. Consider investing individually versus via a mutual fund. The mutual fund managers choose the securities and provide continual monitoring of the firms. Because they pool funds from many investors, they can trade in larger quantities and reduce transaction costs. With a mutual fund, you can cash out at any time, providing significant liquidity. Fund managers can also provide both maturity and denomination intermediation. Big terms. Maturity intermediation means a financial institution can better bear the risk of mismatching the maturities of their assets and liabilities. Denomination intermediation means financial intermediaries pooling small investors' funds allows them to overcome the constraints to buying assets with large minimum denomination sizes. Financial intermediaries also benefit the overall economy in a variety of ways. The Fed executes monetary policy through financial intermediaries. Financial intermediaries provide sources of credit funding for some sectors of the economy. Intergenerational wealth transfer. This refers to life insurance and pensions. And financial intermediaries provide check clearing and wire transfer services. Financial intermediaries are exposed to a wide variety of risk. Stocks, bonds, or loans may default. International investments face foreign exchange and sovereign risk. Interest rate risk can come from mismatching the maturities of assets and liabilities. If a financial intermediary trades for their own account, they're exposed to market risk. Off-balance sheet risk refers to holding contingent assets and liabilities off the balance sheet. Liquidity risk can come from withdrawals. Technology and operational risk should be obvious. As financial intermediaries, they require substantial back-office operations to support their business. And finally, they face the risk of insolvency if they don't have enough reserves to offset a sudden loss. Financial institutions are heavily regulated, basically to protect against market failures. Regulation does impose a burden on firms. Until 1999, most changes were aimed at deregulation, culminating with the Gramm-Leach-Bliley Act of 1999, which repealed the 1933 Glass-Steagall Act. Glass-Steagall separated investment banking from retail banking. The overall intent of regulation is to minimize the burden on those regulated while maximizing social welfare. It's a conflicting combination. Both financial markets and institutions have become much more international. Domestic investors look to diversify globally, while foreign investors are doing the same. Information on all markets is readily available online. Deregulation is allowing more access to markets across the globe. We'll look at various ways for domestic investors to participate globally with the least risk. The U.S. is the largest debt market, closely followed by the U.K. and Germany. Germany is the largest money market. The U.S. is the largest equity market, by far almost 4 times as large as the second largest, which is Japan. This ends the introduction to financial markets and institutions.